Question number 6 of interest rate risk management. Very, very important. Why? Because they have changed the designing of the question. So, CA Institute, if it is so sincere regarding changing the designing of the sum, you can understand that this is in their radar and this sum can come in the exam. Please do the sum. Let's look at the question. So, eSpaces is a consumer electronic wholesaler. It has a seasonal business, 6 months of the year, huge cash deposit, so it has to invest. And 6 months there is a cash crunch leading to borrowing. It is expected that the firm shall borrow a sum of £25 million for the entire period of slack season in about 3 months. So after 3 months, they have to borrow 25 million for 6 months. Okay. So after 3 months for 6 months, so we require 3 into 9 FRA we should buy because we are going to borrow. So we are afraid of rate rising. Banker of the firm has given the following quotations. So spot 3 into 6, 3 into 9. So 3 into 9 you can see 5.94%. So if we buy FRA, our interest cost gets locked at 5.94%. Okay, now we are not afraid of rate going up. 3 month £50,000 futures contract. Maturity 3 months, it's quoted at 94.15. Now, first of all, understand that euro-dollar futures, okay, or euro-pound futures is not explicitly there covered anywhere in the curriculum. But the institute has the right to give it. So, the way you should approach it, I had explained in class, is that the euro-dollar, euro-pound futures, they are quoted as 100 minus LIBOR. 100 minus LIBOR. So, when the quotation is 94.15, it implies 5.85%. 94.15 means the quotation is 5.85%. So basically it's an FRA at 5.85%. That's the best way of understanding. We have an FRA at 5.85%. Of course, it's a futures contract, so you know there's a problem of standardization. Now the first problem is that it's 3 month £50,000 futures contract. That means the underlying after 3 months is of 3 months. But we know that we want to borrow for 6 months. So if the interest rate goes up, we will lose on the higher rate over a period of 6 months. But the futures contract is only for 3 months. That means we have to do double the number of contracts. So the number of contracts that we have to go for shall be the amount that we have to borrow, that is 25 million, divided by the lot size, which is 50,000, the whole multiplied by duration of the loan, which is 6 months, divided by duration of the futures contract, which is 3 months. I repeat, exposure, that is 25 million, divided by lot size, which is 50,000, the whole multiplied by duration of the loan, which is 6 months, divided by duration of the future, which is 3 months. So indirectly it's 2 times. Okay, so that you have to remember. Okay, I'll speak further about it as we read the question. Advise the position to be taken in the futures market. Now, very important position. Now, if it is FRA and we are going to borrow, we obviously buy, because hedging means what? If you are afraid of interest rate rising, you have to buy FRA so that you are protected against it. But since the quotation of the futures is 100 minus LIBOR, so if LIBOR rises, futures will fall. If LIBOR rises, futures will fall. So we are supposed to sell. So it's given, advise the position to be taken in the futures market by the firm to hedge its interest rate risk. So the firm should sell, okay, and demonstrate how the 3 month futures contract shall be useful for the firm if later interest rate turns out to be 4.5%, 6.5%. Okay, 2 cases. So if the rate turns out to be 4.5%, so 100 minus 4.5 is what? 100 minus 4.5 is 95.5, correct? Now, we sold futures initially at 94.15, but the futures price has become 95.5. I repeat, we sold futures F minus at 94.15. The futures price has become 95.5. So how much are we losing? Okay, because the rate has gone up. 95.5 minus 94.15, that is 1.35%. So you can calculate the loss. 1.35% of 50,000 into 3 by 12 into number of contracts. I repeat, 1.35% of 50,000 into 3 by 12 into number of contracts. Hope you remember the number of contracts would be 25 million divided by 50,000, the whole into 6 by 3. Okay, so that is the number of contracts. So the loss on the futures is 1.35% of 50,000 into 3 by 12 into number of contracts. Please calculate that loss. And now you have to borrow from the market at the market rate, which is 4.5%. So you calculate the interest cost from the market. The interest cost from the market shall be 4.5% of 25 million into 6 by 12. 4.5% of 25 million into 6 by 12. Add both the two costs, the cost of borrowing as well as the loss on the futures, and you get the total cost. That total cost divided by 25 million into 100 into 12 by 6. The total cost divided by 25 million into 100 into 12 by 6, and that is equal to your annualized cost. That is equal to your annualized cost. Okay, I think it will come to around 5.85%. That's what it should come to around. Okay, so you can do your calculations. It should come to around 5.85%. Now case 2. LIBOR becomes 6.5%. If LIBOR becomes 6.5%, the futures will quote at 100 minus 6.5. That is 93.5. Okay, 93.5. So you sold futures at 94.15, sold futures, okay, F minus 94.15, the rate has become 93.5. So this time we are gaining how much? We are gaining 0.65% of 50,000 into 3 by 12 into number of contracts. I repeat, 0.65% of 50,000 into 3 by 12 into number of contracts, and this is a profit. Now we borrow from the market at 6.5%. So our borrowing cost is 6.5% of 25 million into 6 by 12. Calculate that. From that you deduct the profit on futures. You get the net cost. Net cost by 25 million into 100 into 12 by 6. That is equal to your annualized effective interest cost, which will come to 5.85%. The best part is that you know the answer. The answer will come to 5.85%. Okay. Very important. Very, 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 very important. You will repent if you have not listened to this and not done the question. Second part. Evaluate whether the interest cost to space plastic should be less had it adopted the route of FRA instead of futures contract. So if it went for FRA, whether the cost would have been lower. Okay, let's check it out. So what was the FRA rate? Oh, 5.94%, because 3 into 9 FRA if you buy 5.94. So the cost would have been higher, because under futures contract our cost is 5.85%. And if we go for FRA, the cost is 5.94%. So the FRA would have been costlier. So the answer to the B is no. Okay. FRA would have been costly. It would not have been cheaper. In the note, they're writing no time value of money in settlement amount for futures contract. Okay. Okay. So we have anyways not considered the timing, that the profit on futures comes at what point of time. Okay. Whereas the interest cost goes at what point of time. Okay. Perfect. So this is the question, very, very important. Please prepare it nicely. Thank you. Now question number 8 on IRRM. It would be a disrespect if I were to solve this sum in the Dawn series. The sum can come, but it is such a simple sum and done 100 times. And this is not a new sum. This is like a sum 15 years ago. Okay. You have to calculate the fixed payment at 6%. You have to remember that while calculating the fixed payment, you have to do 30 by 360 day basis. So I think it's 6 months, so 180 by 360. And then in the second part, you have to calculate the floating payment. Okay, the LIBOR is given 5%. But while calculating the floating payment, you have to do actual by 360. That means I think it comes to 181 by 360. And in the third part, you have to find out the net. Okay, in this case, floating is less than fixed. So you have to find out the net payment. There's nothing there in the sum. There is no question of anybody thinking that, sir, you did not give time and properly discuss the solution. Question number 9 is on equity swap. And equity swap, as you know, is a very simple calculation. One leg is equity and the other leg can be fixed or floating or another equity. One leg will be equity and the other leg can be fixed rate or floating rate on another equity. Let's see. CMT Pension Fund has a portfolio of shares of diversified companies valued 800 crores. It enters into a swap. So we can understand, if it has a portfolio, why is it entering into a swap? Because it might be afraid of equity markets falling. So if equity markets falls, it will lose on its portfolio. So it wants to hedge the same. Into a swap arrangement with Boom Bank on the terms that it will get 1.15% quarterly on a notional principal of 800 crores in exchange of return on portfolio, which is exactly tracking the Sensex, which is presently 43,200. Perfect. So if you imagine the diagram, we are CMT Pension Fund and there is the Boom Bank. Okay. So CMT will receive 1.15% and CMT will pay return on Sensex. CMT will receive 1.15% and CMT will pay return on Sensex. Correct? Okay, perfect. Now, 43,200 is the Sensex value. You are required to determine the net payment to be received and paid if Sensex turns out to be 43,720, 43,560, 44,160, 43,920 at the end of each quarter. Make calculation in rupees crore and round off calculations up to 4 decimal points. So this is easy stuff. You just have to find out the return on the Sensex every quarter. If the Sensex moves from 43,200 to 43,720, what is the return? It is 520 divided by 43,200 into 100. And so on. So find out the return every quarter. Now that, whatever interest you get, that of 800 crores is what CMT has to pay. Correct? And 1.15% of 800 crore is what CMT's got to receive. So receive minus paid, find out the net amount. Things cannot be easier than this. This is like heights of easy. Okay? So please do the sum properly. Do not be surprised if the sum comes. It's a new thing. It's very easy. And remember that, for example, in the second quarter, I think Sensex has fallen, from 43,720 to 43,560. So the return on Sensex is negative. So return on Sensex CMT is supposed to pay. So it's supposed to pay negative. That means it will receive that. So don't be surprised or embarrassed by the fact. Okay, if the Sensex return has fallen and I'm supposed to pay you a negative return, that means I will receive that amount from you. So I'll receive 1.15%. I will also receive that negative return. Okay. So question number 10 of IRM, very important sum. It is on T-bond futures. And if you remember, T-bond futures, although they are physically settled, which means that if somebody does not square them off, then on maturity, the long has to pay and take delivery. The short has to give the delivery. So they are physically settled, but the underlying T-bond does not exist. Okay, you are understanding the problem. The underlying T-bond which has to be delivered does not exist. So if you have gone short on the futures, you are supposed to deliver on maturity, but you can't deliver because the thing is not there. So in that case, there is a basket of deliverable bonds, that is similar bonds which the exchange announces, and it is the short, the F minus, who decides which bond to deliver. So obviously the short will decide upon the cheapest bond to deliver. Okay, the cheapest bond, the CTD. But the exchange is also smart. It knows that the short will do that. So it announces conversion factor for each bond, such that a bad bond, okay, will have a low conversion factor and a good bond will have a high conversion factor. Now, usually when we deliver something on the futures contract, we got to receive F, but in the case of T-bond futures, we don't receive the futures price. We'll receive futures price into conversion factor. So if you deliver a cheap bond, you will receive lesser amount, F into CF. If you deliver a good bond, you will receive a higher amount, F into CF. So the profit to the short on delivery will be F into CF minus S. F into CF minus S, which means futures price into conversion factor minus the spot price. So why minus spot price? Because he has to purchase from the market, the particular bond. F into CF minus S. So let's look at the sum now. In March 2020, XYZ Bank sold some 7% interest rate futures underlying notional 7.5% coupon bond. 7.5% is the underlying bond which does not exist. The exchange provides following details of eligible securities that can be delivered. Look at the securities. None of the securities are 7.5% coupon securities. So we have the basket of other securities. Quoted price, this is the S, this column is S. And conversion factor is the last column which got to be multiplied by the futures price. Recommend the security that should be delivered by XYZ Bank if futures settlement price is 1,000. So accordingly, your answer, the framing of your answer will be XYZ Bank will deliver the CTD, the cheapest to deliver bond. It is the bond which will make XYZ Bank the highest profit. Profit is equal to F into CF minus S. So for the first bond, what is F? 1000. F is 1000 for all bonds. What is CF? 1.0370. So 1000 into 1.0370, which is like 1037 minus S. S is 1037.4. So 1037 minus 1037.4, it is minus 0.4. Okay, so profit is negative. Second bond, 1000 into 0.906, that is 906 minus 926.4. So it's minus 20.4. Very bad. Third bond, 1000 into 0.9195 minus 877.5. So it's 919.5 minus 877.5. Yeah, you have a good profit over here. Fourth bond, 964.3 minus 972. Negative, bad. Fifth bond, 1173.4 minus 1146. Profit, good. Last bond, 1242.8 minus 1201. Good. You have profit. So whichever gives you a highest profit, that shall be your cheapest to deliver bond. Okay. Now one thing I will caution you, the quoted price which is given to us, okay, in the second column, that is given in decimals. Whereas in T-bond futures, what I taught you in class is that the tick is not in terms of basis point, it is in terms of 1 by 32%, 1 by 32%. So if in the exam, the quoted price is given like 1037-16, 1037-16, it means 1037 plus 16 by 32. 1037 plus 16 by 32, which comes to 1037.5. I know many people will not listen as to what he is saying, but when it comes in the exam, then they will raise the red flag and stand as if they were not taught. This was taught in class. I had explained T-bond futures, how they are quoted. Open your copy if you have taken classes from me and check that how the T-bond futures are quoted. After the dash, that part has to be divided by 32 to get the decimal points. Thank you. Now question number 11 is on two-party swap. I have already discussed 2 questions on two-party swap. So I was going to skip this question, but then I remembered that this is the question where they have given a wrong question, in the sense that after the table, see, IM wishes to borrow USD at a floating rate. Now the rate is LIBOR plus 0.5, and JI wishes to borrow Japanese yen at a fixed rate. The rate is 4.25. If you carefully check, LIBOR plus 0.5 is better than LIBOR plus 2.5 to the extent of 2%. 4.25 is inferior to 4 to the extent of 0.25%. Now, obviously, this is what they should do. IM should borrow USD floating. JI should borrow at 4.25. But they are saying wishes to borrow. And we have always understood that in a two-party swap sum, whatever a person wants to borrow, he will not borrow that. He will borrow opposite. So here the opposite is not acting, which means they have done a mistake. So after the table, I'm talking about the question, the first line is wrong. The first line should have been JI wishes to borrow USD at a floating rate and IM wishes to borrow JPY at a fixed rate. So the first line is wrong. I repeat, JI wishes to borrow USD at a floating rate, while IM wishes to borrow JPY at a fixed rate. So in that case, we will underline LIBOR plus 2.5 and 4%, and we will star LIBOR plus 0.5 and 4.25, and then the sum will proceed. Okay, you have understood the stuff. If you are frustrated, don't do the sum. There are 2 sums I have already done. Otherwise, this sum is designed wrongly because of that line which is given over there. Okay, rest depends on you. Do not unnecessarily raise doubts about the sum because the sum is wrong. What can I do? Okay, so either don't do the sum, because there are 2 other sums we have done, or if you are smart enough, you have understood, okay, the first line after the table is wrong. By the way, solution is correct. Whatever solution institute has done is correct. Okay. Question number 12. Question number 12 is on cap and floor. The question is not conceptually correct. There are mistakes in the question, but let's focus on the solution, because if you are smart, you can understand what the institute is wanting. So you can point out that there are mistakes in the designing of the question. Yes, there are. However, if you are smart, it's possible to understand what they are wanting. Let's see. A textile manufacturer has taken a floating rate loan of 4 crores on 1st April 18. He's taken a floating rate loan. The rate of interest at the inception is 8.5%. So we know that in a floating rate structure, interest rate at the reset period is applicable for that period. Now, for the first year, rate should be 8.5. Okay. And the duration of the loan is 4 years. So we should only be concerned about interest rate rising in 3 years, because the first year is over. Over in the sense the first year the rate is decided. In the month of October 18, the Central Bank of the country releases following projections about the interest rates likely to prevail. So these are the forecasts offered by the central bank, these 4 forecasts. Now I believe the last forecast 7.75 is relevant because that will be applicable for 2023, but the loan ends in 2022 only. Show how this borrower can hedge risk arising out of the expected rise in the rate of interest when he wants to peg the interest cost at 8.5%. So if you want to limit your cost to 8.5%, you want it to be lower, but you don't want to be higher than 8.5. That means you want the upside hedge, but you want to enjoy the downside. You'll obviously advise what? An interest rate cap. Okay, the company should buy an interest rate cap. That means a portfolio of call options at 8.5% strike price on 4 crores every year. That way, the company has to pay an initial premium, because when you buy a call option, you pay premium, na? That's not given in the first part. So you have to pay an initial premium, and in return for the premium, whenever the rate goes above 8.5, the other party will give you the difference, like call option. If I say in Hindi, ऊपर जाने से difference आता है. So if the rate goes above, we'll get the difference. So we'll be hedged against a rise above 8.5%. So that is the theory part. In the first part, you'll have to explain buy an interest rate cap. What's the strike price? 8.5%. What's the maturity? 4 years. Okay. What's the notional principal? 4 crores. What's the premium? We don't know. Will be negotiated. Whenever the rate goes above 8.5, we will get the difference. If the rate goes below 8.5, the caplet for that particular year will lapse, and we'll enjoy paying a lower rate in the market from the place that we borrowed. Perfect. Now, I hope you did not miss out if the audio missed out. So we buy an interest rate cap at a strike price of 8.5% for 4 years. Okay. On a notional principal of 4 crores. So whenever the rate goes above 8.5%, we will be protected because we'll get the difference. And if the rate goes below 8.5, we are not afraid because we'll enjoy, we'll buy from the market. We will pay interest in the market and the cap will lapse. Second part, assume that the premium negotiated by both the parties is 0.75% to be paid on 1st October 18, and the actual rate of interest on the respective due dates happens to be as follows. Show how the settlement will be executed on the prospective interest due dates. So these are the 4 rates. Now I don't understand what is the relevance of the last rate, 8.25, because that rate shall be applicable for the year 2020-23. The first rate is already known, 8.5, when the sum started. So we should be concerned only with 10.2, 11.5, 9.25. But so much of brains if these people had in that case, so I should never have criticized them at all. So you know what they will do. They will compare 10.2 with 8.5. They will say call option exercised. So you will get how much? 10.2 minus 8.5. That whole percentage of 4 crores. Next year 11.5 minus 8.5. The whole percentage of 4 crores. Next year 9.25 minus 8.5. The whole percentage of 8 crores. Next year lapse 0. So we get these figures. This is the wrong solution, but this is what you have to do. And initially you have to pay a premium, 0.75% of that 4 crores. So that's the solution, that by buying the cap, the firm is getting hedged away. When the rate rose to 10.2, 11.5, 9.25, the firm got the difference. Okay, that way.